Thank you. Thank you. My name is Chad Giussani. I'm head of transaction reporting compliance for Standard Chartered Bank. Or at least I will be for another month and a half. And then after that, I'm moving to a new venture called hub.com, where I will be building regulatory reporting services for buy-side clients. So slight departure from compliance and back into the first line. I'd like to introduce our panelists. Oh, before we start, we will be taking questions as we go through. You have to go to the Brella app and go to the bottom toolbar, click 3 dots, then Q&A. Those questions will appear here, and we'll tackle them as we go along so we can get some real-time feedback from the audience. Would be kind of great. So I'd like to introduce Beju.
Hi everyone, I'm Beju Shah. I'm Special Advisor for Digital Innovation at the Bank of England. I work across a number of topics, been very involved with the Future of Finance initiative, but also around a lot of our initiatives around RegTech and also payments innovation as well.
Good afternoon, I'm Daud Hark. I work for Deutsche Bank in an area called Market Initiatives, Regulatory Transformation and Strategy. It's a long business card. And my role is global. I look at all regulations as they impact the bank, and so not just on the reporting side, so we'll touch on the wider scope of RegTech during this talk, I hope.
Thank you. Just prep, just in case. Right, so we've prepared in advance, and the first question that we were asked to address was, what are the regulatory concerns as a result of the adoption of RegTech, and how can these concerns be addressed?
So I think let me just start off by saying that anything that I do share in this session are my own opinions and not necessarily those of the Bank of England. I don't want to get in trouble. But yeah, I think in terms of regulatory concerns, really, I think we've seen over the years I've been involved with RegTech and helping the bank think about this and how to kind of engage with it better over the years. Fundamentally, it comes back for me to making sure the right foundations are in place and how you're building these systems. Data quality is probably high up there. The use of AI, but particularly within the use of AI, the ethical use, the bias that's inherent within the data, the black box treatment, but also making sure that any decisions that are taken using AI-based systems are transparent and human checks are built in. But fundamentally, ultimately, it comes back, the core thing, I think, at the front of our minds, certainly at the front of my mind, is around data quality. And also the standards that underpin the data that we use, having that commonality around that, making sure people are doing things in a consistent way. And one last point is really around actually the speed at which that some of this can be deployed. There is that perception that some of this can be really fast, really quick, really a magic silver bullet, and I don't believe that to be the case. I think this is something that we should be aiming for, continue building towards, but actually that requires patience. For example, if you are deploying machine learning models and so on, actually what is required to train them, and are we considering things like data quality, the bias, and actually who's training these machines and so on. So working with a bit more patience, with focusing on quality, but also collaborating, across the industry with the regulator is going to be really key to making sure that actually RegTech solutions can be deployed and used effectively, but also the regulator really understands what's being deployed as well and is comfortable with that too.
I think that was fascinating. That's one of the reasons I like these type of conferences, is where you can hear from the regulator directly on what they're thinking in this space, and my experience echoes that completely. So when we look at a RegTech solution being brought into the bank, and I'm talking generically here, not about just Deutsche. I've worked across the entire industry, from Merrill Lynch, Goldman's, JP Morgan, Barclays, RBS, etc., all of them in the reg space. And when people are implementing change and they're bringing in a RegTech solution, there are islands of change in your organization. Very akin to the old days when we used to work in silos, in asset class silos. And the same is now true when we look at RegTech solutions. It's either being brought into fixed income, being brought into FX, being brought into legal, or being brought into, say, for example, compliance. But that is it's a very narrow use case and a very narrow benefit case that those RegTech solutions are bringing, and no one is preparing the ground for the implementation of a solution. So nobody's thinking back to how do we normalize the data that's being used? How do we create the environment where this RegTech solution can actually bring value to the firm? How wide can we spread the RegTech solution to bring in other areas? So for example, if it was going into compliance, how do we pull legal into that so that documents are digitized in advance and the data is normalized from there, so that then legal, compliance can then have a foundation to be able to measure the compliance on, and that's not happening. So, and then if we look across the firms, not just an individual firm and the islands, it's an archipelago of compliance. So you'll find that each firm has multiple small islands within it with different RegTech solutions, and then there is no strategic approach within the firm, and then across the entire piece, it's a mess. So, and none of those are interoperable. And so that is the concern, I think, that, as Beju's just said, of, you know, when that data then comes back to the regulator, they're going to find a very inconsistent picture. And so we need to think not just internally within a firm of your strategy for implementation of these solutions, but across the entire industry. What do we want to do as the foundational building blocks for the implementation of this? Do we want to bring in a common language like the common domain model from ISDA? Do we want to implement new standards such as the ISO standards, which we're looking at today for UPI, UTI, CDE? And what else do we need to bring in? And if we look at the prudential side of the regulation versus the transparency regulations, they're completely different places. RegTech solutions, I would hope, cover both.
Thank you. So my experience at my bank has certainly been that there are these little technological islands. What we have done is as part of the reg reporting overhaul that began at the bank probably about 5-6 years ago, we've now introduced the concept of a data lake. And so, but that didn't work either. So we had to have a pre-data lake where people drop stuff, and then it gets scraped into a more sort of a homogenized lake of structured data for our end reporting. Having done that, we were then able to retrofit our G20 derivatives reporting back into the lake because the data there was a lot more clean, hygienic, normalized. And that's just an incremental step in moving to another strategic reporting platform.
Yeah, so just to go back on that point, actually. So one of the things that you'll hear a lot about, and we have done over the last few years, is around distributed ledger and about that networking effect. And obviously underpinning a distributed ledger needs to be a common set of standards across the entire industry. And one of the things that's been looked at for that is to create these data lakes, which are normalized data, which then form the nodes within your distributed ledger so people can talk to each other. The problem with that is because the standards and the language being used is not native to each of the firms, and it's only being used in the lake, the transformation from your non-native language to the native language will hide a lot of problems and will obscure that from that transmission, and so create a lot of backwash back into the firm when your own books and records do not match your data lake. And I think that's the hidden cost that has yet to be considered when we look at this new transformation in data and transferal of information.
We see that obviously in the prudential reporting space as well, because there's so many levels of aggregation. A lot of data quality issues get masked or they get manually transformed, and actually they proceed up the chain. Well, actually, what we're trying to do now through some of the work that's going on in the bank through the Transforming Data Collection Initiative is trying to look at actually how some of that data can be improved, how those supply chains of data can be improved, working with the industry to make sure that actually it works for both sides. So you're closing that gap or closing out any issues that can result in data quality issues and so on. But it's a slow burn task because a lot of these regulations are in place. They are going to be in place for some time. Unwinding them, changing them is costly. There has to be a business case to justify it on both sides as well. But I think that's easier when we are all working together. So, I was speaking to, I think Angus Moore was here earlier, but I spoke to him yesterday and he gave me an update on how that work is going. I think they've got like 100 participants across 45 firms. from insurers to banks to FMIs and so on. So it's really, really encouraging for me to hear that, because I've been kind of driving this at the bank for the last 5 or 6 years to see actually we are moving in the right direction. There is a great awareness of these standards, this common language, but also recognizing that different types of reporting require different solutions. But the commonality to all of that is having this common language and the ability to collaborate together.
So that's probably a really nice segue into the next part, which was how is the role of what has been the role of the regulator in the regulatory reporting initiative that the Bank of England are running, but also we'll extend this out to other regulations, so FCA as well, and maybe what's been done. What do you think's been done well to date?
So I think over the last few years, certainly from my point of view, was actually getting this view that things need to be standardised and we need a good solid foundation. That's been the focus, particularly early on when I was kind of driving a lot of the initiatives. So using common technology standards, particularly around prudential reporting, because I know that when CRR and Solvency II and other things came in, those things weren't designed with a digital first view in mind or for a digital ecosystem. Yes, the technologies enabled the information to be delivered digitally, but we weren't thinking about it in that right way. And so learning some of the lessons from that, learning also how we deliver change and the impact of the industry, and speaking to many of you at these sorts of conferences over the years, we realised we needed to do things in a more simpler way. So actually having, setting some guidance around, look, we're going to be using this technology for this purpose, we're going to be using these standards, provided certainty to the industry around actually the direction of travel. Since then, obviously, we've done a lot of work around actually, look, we do need to focus more around how we're collecting this data, reuse, minimising the burden, not asking for things multiple times. We've made mistakes along the way, that's inevitable, but we do need the data. But learning from that, going, actually, we can do things a bit more efficiently. So that led to, actually, that we've got a good baseline in. Everyone's engaged both within our organisation and in the industry, and that desire is there to move forward. The Transforming Data Collection initiative has been really useful in bringing people together to focus around what standards are required. It's going to be a slow burn. It's going to require, that constant focus. It's going to require kind of tenacity to keep going. But actually, hopefully, the results should be there, over a period of years, and we can start rolling these things out. I think the other thing is what's really happened in our organisation is that there is that senior level buy-in. There is that recognition that this is really important, that actually you need to be digital first now and actually start thinking about how you realise these efficiencies through the deployment of technology. And that has to be it's not just a top-down thing. There has to be a culture and mindset shift within the regulator as well to understand how these technologies can be used, how they can be deployed, and actually what's required to deliver that change. Is not an overnight silver bullet. I mean, I remember sitting in this room about 3 years ago. It's like, yeah, we're going to do this. Actually, I was at a conference I got invited to speak at the British Embassy in Tokyo, and I remember one of the ministers came up on stage and said, the Bank of England and the FCA are going to automate regulatory compliance in the next year. And I kind of went pale because I was on stage after him, and I was like, who the hell gave him this line, right? And I said to him quietly afterwards, I said, whoever's told you this is telling you porkies, because that isn't the case. There's a lot of groundwork to do. I mean, look, simple things. Legal entity identifiers, really, really good idea. People love them, people hate them, but people hate them not because of their utilities, because of the cost and the admin burden. But a lot of that is trying to be dealt with in the background, in terms of actually that system was built for a non-digital world. And so we've taken that feedback on board, but to work through the governance, to get global harmonization around that, to get all the regulators around the room. And I sit on the ROC plenary, and to get that agreement so we can drive that change forward does take time, but it's not that those concerns haven't been listened to. It's making sure that you can drive that change and get that implemented. And I think the other thing is, back to the collaboration point, on initiatives like that, it does require you guys from the industry to also say, we're going to use this, we want to use this, even kind of talking to government saying, this is really important, right, for us, and actually, can you do something more? Because there's only so much we can do within our powers, within the regulations that we look after and the policies we look after. But I think, there's some things that I think, to your question, what's gone well is actually speaking, being on the ground, come to these events, and trying to foster that collaboration, being very clear about the standards and technology choices and data approaches that we're using, and having this focus, raising the profile internally, and then actually getting out there to drive further change on top of that to see how we can streamline things. It's not going to be easy, but it does require us all working together.
We only have half an hour left. Well, less than that, and that's top. No, it's a huge topic, and it has many different aspects and angles to it. I've always been a market forces guy from way back when I was a trader. So I have always believed that we can self-regulate to a great extent, and that through the benefit case of having good quality data going through the value chain from pre-execution all the way through to settlements and documentation has a business case of its own. You don't need to necessarily have that regulated. But what I have also seen is a lot of friction because we're using legacy systems that were built 30, 40 years ago and get patched to update them. And so make good with what you've got rather than do it better has been the ethos of the market. And certainly as the spreads have gone down and the P&L has gone down and how much we make has gone down, we have stopped doing the innovation that we did when I first started in the industry of remaking the whole stack every couple of years. That has now stopped. We haven't got the innovation anymore of new technologies coming in and being able to completely transform the way we do our business. Because it costs too much. So now having the regulatory stick to say you must do this has been the biggest reason for change that we've had in recent years. So even though I'm a market forces guy, I do appreciate the regulator has a great deal now to play in this in transforming banks into being better public servants. Beju's have a point about this and about the dialogue, conversation, the collaboration between banks and regulators. That's improved a huge amount in the time I've been in banking. It used to be an us and them, and it's now very much a question of when are we going to see Beju, when are we going to go see Angus, when are we going to go and see our friends at the FCA or at BaFin, and how do we tailor our conversations to only the things that can fit in the 2 hours, 3 hours that we have with them every month, rather than before when it was just like, oh my God, what do I have to say on this one topic? There's so many things to talk about because we know that the regulator is now here not only for us to share the issues that we found, but also the problems that we're facing and how the regulator can help us in that conversation with the wider community. And that is a huge mindset change to the way we used to work. And for the better, much better now. So we're all going through the IBOR change at the moment. All of the big banks are certainly moving their LIBOR positions onto the new risk-free rates. And that has tremendous problems because of the amount of trillions and trillions of OTC derivatives in notional value are changing to the risk-free rate at the same time. And that has many implications from the front to the back of the stack and also into reporting. And being able to have an honest, open dialogue with the regulator on a very regular basis to say, because of your regulation, because of your guidance paper, this is the outcome. Are you aware? Do you want to change that guidance? Has proved really powerful for us as a bank. And so I think that is a huge benefit as well. Going on to the point about the LEIs, so very, very briefly, because you did mention it. And
we've only got 1 hour.
I'm sorry, yeah, exactly. So I will be very, very succinct in this point about the LEIs. The LEI has a very strong benefit case for the banks, right? From a KYC perspective, know your client. Be able to do the portability of a client from one bank to another. It could reduce the cost of KYC, so everybody hasn't got to do the same KYC over and over again, right? And that would improve the whole financial market by reducing the amount of risk that we have to take with clients coming in and bringing dirty money with them. Okay, huge benefits for both us in terms of reduced cost, huge benefits for the industry and the clients. But there are problems, as Beju pointed out. There's the cost involved of the of doing the administration, there's the yearly cost, there's the cost of actually getting them to comply. The lack of integration of the LEI with other business activities that client does. It's not in the business registry. It's not in any of the filings you have to make to regulators. So the only time that they have to use the LEI at the moment is in regulatory reporting. That is not a benefit case for a client at all. There isn't one. Right?
And only when you're the reporting party.
And only when you're the reporting party. So how do you persuade them to do it? Now, China, and I will be very brief, China has had the largest growth of LEIs in the world last year, okay? The reason being, it's free, right? And it's given at the point that the registration of that entity takes place. And it's now used in multiple filings that that entity has to do with the regulators across China. All of a sudden, everyone wants an LEI because they don't have to have multiple different identifiers for different regulators and for different filings. If we did that across the board, it would have a huge take-up. And then, of course, there's the whole thing about, what did you call it, about the agents acting on...
Yeah, so I'm sorry, this was what I was going to build off of was one of the things that's happened since the FSB's thematic review a few years ago, and that resulted in China's kind of increased uptake, is how do you shift the burden back to the people who are getting the benefit, or actually make it more part of the value chain? And one of the things that Glyph has been working on, which I really, really like, and I would love to see more uptake of. If you are from the bank here, I would encourage you to think about this, is the role of the validation agent, whereby actually banks, as part of their onboarding or client management processes and so on, one, they can keep the data more accurate, updated real time as they're doing that as part of their due diligence checks, but they can also issue LEIs as part of doing business, and at a tiny fraction of the cost to what if you went out and got one today, because they can bulk register them. So you're talking sometimes less than $1, maybe 50 cents, for all the other benefits that gives you when integrated into the systems and downstream processes. So, but also it hides the burden from the end client. It's like your vehicle identification number, right? You go into your car, if your car gets stolen or anything like that, you only use it when you need it, and if you do need to use it, it's there. Otherwise, you're oblivious to the fact that it's there. But if, from an operational point of view, a bank or any other organisation has that to then do all the things that Dale's described. So that's a really exciting development, and actually starts shifting how the system is used, and keeps it a bit more real time and up to date. So I would encourage you to think about that.
Just one more second before you drag me off the stage. The LEI is also another really great use case that's coming up now is on corporate actions. Okay, so we as an industry, it's a cottage industry in and of itself. Anybody who's gone into a corporate action department within a bank sees hundreds of people across the floor, and every single day you're just struggling to keep up. So the LEI, there's a new use case for LEIs in corporate actions where they will become the golden source of when there's a merger, when there's an acquisition, and that could transform the way that we do corporate actions in a bank, and that will also transform equity derivatives.
So the question originally, if we go back to 35 minutes ago, was what went well and what didn't. And actually the concept of the validation agent, I'm going to push back and say 5 or 6 years ago I was at a conference and someone from the FCA was up. We were talking about the introduction of MiFID II and the mandatory use of LEIs under MiFID II. And I said to the person from the FCA, why is it that you don't make all the firms you regulate have an LEI as a validation agent? To date, they still don't. What the FCA do is they issue you an FRN, an FCA reference number. And that firm is recognised by the 6/7-digit FRN. FCA will also sell you a list of all the firms and all the FRNs for £7,000 a year. So they can maintain their own unique identifier and they commercialise it.
When you can get it off Glyph for free.
When you can get it off Glyph for free, or the regulator could have become a validation agent and just insist as part of their onboarding to the FCA as a regulated entity, they attracted the LEI. And if there's anyone in the FCA here, I'm going to run that way.
I couldn't possibly comment.
That's absolutely. My views are also my own.
Yeah, I mean, look, there's clearly an issue there, and that would be the ideal situation. And actually, it puzzles me a little bit, but that's about as much as I'm going to say on it. I find it puzzling, but I think the more of you that can help us in this to say we would like to see this and this is what the benefit you can get would also help, because sometimes actually the outside view will help as well, and particularly the wider ecosystem sometimes. So yeah, I mean, saying that the FCA with all their recent announcements and recent appointments are shifting towards a more data-driven data focus with all their new hires. So there's an opportunity for me to have a conversation with a whole new structure as well to see actually where their thinking's at as well. So, but yeah, the more also you can support us with that and that voice, that'd be really good. So.
Brilliant. Thank you. Thank you. It's going to be quite a specific question now around, because this is coming up more and more frequently. As the regulations land as part of the Lamfalussy process in Europe, you get to the final stage where you do the retrospective look back and you start to rewrite your regulations. You effectively look at what went well and what didn't. And we're starting to see a mere refit for reporting, and we'll expect to see something for MiFID reporting fairly soon, probably 2 years off. One of the big things about the last rewrite of EMIR was and MiFID, in fact, was the right of MiFID was the introduction of mandatory use of ISINs for OTC derivatives. And I don't know if you're particularly familiar with it, but I'm sure you've got some opinions on this. Did ISINs for OTC derivatives work? And why I ask this is because the concept of mandatory use of ISINs is coming up, we expect, in the next FCA review for EMIR reporting. Did it work?
So for transparency, I sit on the DSB ANA product committee, and DSB ANA are the publishers of OTC ISINs. They were given the license to do so by the FSB. I used to sit on and is the board that designed ISINs. So for OTC derivatives. So ISIN was always, I'll lean forward here, ISIN was always a tactical delivery while we waited for the UPI, the unique product identifier. So ISIN is a product taxonomy, let's call it, so to be simple. And it's a way of regulators being able to aggregate financial instruments effectively. And ISIN was only introduced for Europe originally because Europe was bored of waiting for the implementation of the UPI, the development, and then the implementation of the UPI as a global standard. Because if we go back to the FSB original consultation on transparency for risk mitigation of systemic risk, one of the things that they asked for was a universal product taxonomy for the aggregation cross-border of financial derivatives. And that's where it comes from. So that's where the ISIN comes from. The ISIN was only ever taken up in Europe, and the rollout has been patchy, as has the standards used, because this goes back to the whole thing we were talking about earlier about the transformation that is required to create an ISIN. So what I call an apple, somebody else might call a pear. And when you go to ask for an ISIN from the DSB ANA, we both get exactly the same ISIN back. So from a regulatory perspective of the outcome, the aggregation is incorrect. So the ISIN has fundamental flaws and problems. Now, the UPI is on the horizon. We should be getting, again, the DSB ANA are going to be the publishers for the UPI. That should be coming by the end of the year, of this year, okay? And then it's going to be added to people's rule books. We're going to see it in, I think the first implementation was going to be the CFTC rewrite, which is happening in May 25th, 2023. But that isn't going to be, 2022, sorry, but it's not going to be ready for that. So the first implementation I expect to be the EMIR rewrite, which is around Q1, Q2 2023. And then beyond that, then the CFTC will do a second rewrite, and then ASIC, MAS, Hong Kong, etc., are going to update their rule books to include that in late 23, early 24. Now, that will be the way to do cross-border, finally, but the problem being is that we haven't solved the problem internally within firms, or more importantly, between firms, of how to create a common standard for the modelling of a derivative. And so I will continue to call something an apple, and somebody else will be calling it a pear, and we'll both get the same UPI. So we aren't ever going to solve the underlying problem of the inconsistency until we have a universal approach to standardization of the description of a derivative product. That was a very long... Sorry, that was very long.
You could have said no.
I could have said no.
Thank you. Question for you. You talked about harmonization of approach for gathering the ISIN being important, almost like a best practice. So question from Wenjai in the audience. How important is regulatory harmonization to reduce the regulatory change burden for firms? And I'm going to tie this back to a conversation we had yesterday, which was around the introduction of Brexit. And now the banks have to support two sets of reporting regimes, and the way that the directives and regulations were onboarded, there was some slight delta between the two. So we already now have more almost a doubling up of reporting regimes because they weren't exactly verbatim copy-paste. How important do you think it is that all of that critical data element work, the common domain model, that really does keep pushing forward, and that maybe the UK and the Europeans and the rest of the world push towards a common goal?
I think, I mean, on the other side, I've been seeing over the last few years, overseeing the implementation of the governance of the UPI, UTI and CD more from a technology and standards governance point of view. But to answer your question, the harmonisation aspect is absolutely critical, and that must push ahead, because that was also one of the reasons for introducing the UPI, UTI and CD. Was actually there were some problems of what came before. How do we harmonise? And that's taken a long time just to get to this point. Now, if at this point it doesn't achieve the goals, then I think there's been a massive failure. So there has to be that consistency. But that's not just in these standards, that's on everything that we're doing around reporting going forward, because there is a commonality, there is a common language that has to be applied. There will invariably be local differences, but the things that can be common, that cause the most pain, need to be worked on. Saying that, it's not an overnight fix as well, because if you look at the work that's happened on UPI, UTI, CD, it's taken a lot of time to get there. That's not to say it's without value, but it requires a lot of effort, a lot of collaboration and different groups coming together. But it's only as good as its implementation at the end of the day. So, but yeah, I mean, yeah, just to go back to it, but the harmonisation is absolutely key and should be the thing that's always encouraged and stay in focus.
Fragmentation creates friction. Friction creates cost. Simple as that. So if we look at the widening of the gap between European and UK regulations, we are getting a different set of obligations on UK firms that support UK clients than UK firms supporting EU clients. Actually, at the moment, because a concrete example, the EU has just has a compliance date of the middle of next year for the MiFID II quick fix. The quick fix will reduce the burden on clients for many different things that they have to do, and on firms for the reporting they have to do to those clients, which is to promote growth in Europe. The UK has not implemented the quick fix. Now, so the cost to a UK client is higher than it is in a European client. That's a fact. The opposite side of that, though, is that UK MiFID III is due earlier than EU MiFID III. So we're expecting, after the HMT consultation that just came out, or was just closed, okay, that there'll be significant changes to the MiFID II coming down the line for the UK, and that'll be a lot earlier than the MiFID II changes out of Europe. So that could indeed create a bigger benefit. So regulatory disalignment isn't always a bad thing, because actually, depending on the changes that they bring in, it could actually give a great deal of opportunity to both the firms and to the clients who they serve in those different jurisdictions. Those firms who straddle the UK and Europe and have to do dual reporting across both, there is going to be an increase of cost in doing that. And we may find certain firms have to make hard decisions over what they do in those different jurisdictions. And that will depend on, and hopefully, in my conversations with regulators, they're fully aware of that. Regulatory arbitrage is something that no one wants, in particular regulators. We look at the CCP equivalency, which is due to stop next year. Okay, how the regulators on both sides of the channel deal with that is going to be key to what we can do to help clients. But they're aware of it and it's transparent, so hopefully we'll see.
So fast forward a bit. Things have gone remarkably well in terms of data harmonization. And we get to a kind of utopian point where the world is harmonized. Do you think we ever get to a point where, and this is a question from the audience, Colin, where data will be consistent enough to allow for a consolidated regulatory reporting regime that would just apply across jurisdiction? Would that be part of the ultimate aim, goal? Would that be somewhere nice to be? Or will each regulator say, I still want my own cut because I've got my own markets to regulate?
I think that's a nice utopian vision to have. And people, and we've heard even everyone talking about this for a while, saying, yeah, this is going to be the case. The reality is that I don't believe that's going to be the case. I think you'll have some common things that everyone will use, a common set of languages, but ultimately, as I said in the previous round, that there will be local differences just because of local differences in local markets. But I think if you can deal with the big problems and and making sure that the key things that need to be standardised and harmonised are, and actually even if you have a consistent set of data that everyone requires, and then you have some local variances off of that, that's probably the most pragmatic place I think it's going to get to. It's very nice to say that we'll have global harmonised reporting. And until the nature of the data we're collecting or how we're looking at the data we want changes, or that may lend itself to that. When you, for example, if we're getting more real-time economic data, you may be able to gather things for as digital currencies roll out that may present new opportunities for not surveillance but more monitoring of kind of what's happening on the ground. And that may change things as well, but right now that's not clear. So I think right now the focus should be on making sure we've got those foundations, moving towards those goals where actually things are as common as possible, finding what those efficiencies are. But it's going to be things that will evolve along the way, I think. So it'd be nice to get to that utopian vision, but I don't think that's going to be the case.
So at best we might get more equivalence where almost legal safe harbour.
Yeah, exactly. More commonality, more harmonisation, and therefore the efficiencies around the big ticket items, really. So.
No.
Excellent. I wish you'd started like that.
I know, exactly. We would have been over by now, wouldn't we? So on that point, so I was invited to the FSB Goog to take part in the creation of the UTI, UPI and CDE many years ago now, and then presented at CPR and Moscow on many occasions when they actually went into delving into the actual creation of these standards. And one of the things that was a takeaway for me is that in the breakaway groups where they sat and actually went through these fields, the regulatory divergence in view was marked, depending on which jurisdiction the regulator came from, because they had different ideas about what they wanted to get from these fields and values. And what we're seeing in the implementation stage of the CDE in particular now is that they will use the CDE, which is the Critical Data Element Data Dictionary. It's a group of 103 fields and values which have been standardized. Some of the regulators are taking all of those, some are taking a few of those, and they're forming a kernel in the center of the regulatory obligation. But then on the periphery are the fields which are unique to those jurisdictions. Now, what we might find, and to your point, Chad, is equivalency and then substituted compliance on the kernels, on these core fields that were, and so as long as the regulators can share those with each other cross-border, then we could ditch those and only do one to one regulator and then share with everybody else. But then I don't think we'll ever get away from these peripheral fields that one regulator thinks is really important for them and another regulator doesn't.
We've got one more, well, two questions, but similar in theme. Anonymous and a question from Agnes. So these reports that we submit are quite defined and well structured. But clearly there's other types of data out there. Unstructured data from messaging and apps, voice and video communication. We do capture this within the banks because we have our trade and comm surveillance teams that have to go through this data. But we don't currently onward report it perhaps unless it's in a store report. But do you see that eventually there will become a demand from regulators for more of this unstructured type data, especially app-based stuff where people start to invoke trading and investment decision making, but via a kind of non-standard platforms?
I think sum up shortly, I think in time likely as the nature of the data we want to look at or insights we want to get changed, but also that will need to evolve with our capabilities and skills to kind of take on that, process that, and have the skills for people who can work with that data. But I think it's not inconceivable. I mean, the pandemic also forced quite early on for us to look at other sources of data that came from big tech, data that was happening, you know, port data, all that sort of stuff. So actually that has helped us shift our thinking around what we might need and when and how and what lens that gives us over and above the data we currently collect. So, yeah.
That's very interesting because I had a conversation with somebody from the EBA only the other day about exactly this topic. And until the technology has got to the point where the regulator can pull rather than push, and they have the capability to be able to process and understand what we're sending, not just on an individual firm-by-firm basis, but across the whole piece, across the different regulators, it's worthless, right? So there's going to have to be a lot more standardization or a lot more standard in the way that that information is then translated in order for the regulator to be able to understand it across a larger market.
Thank you. We are just out of time. There is one late question which has come in from Wendy. Wendy, if you really want to know the answer, I think any of us can answer that after this session panel around UPI. But I'd like to thank you both for your contributions today. Good conversation.
Yeah, we could have held on for ages, couldn't we?
Yeah, just on LEIs, right? We could have done 3 hours on that, but maybe next conference.
Okay, thank you. Thank you.